Welcome to this week's series of Credent Connect. And today we want to touch on the unfortunate events that transpired on October 7th in Israel with the invasion of Israel from Hamas. And we're not geopolitical experts, to say the least, on that front, nor are we going to touch on that from a political aspect. Yet the reality of what we're going to talk about is more volatility-based, or the potential of it, in the broader markets. We have seen numerous geopolitical tensions this year, and bleeding in from last year, actually, whether it's the Russia-Ukraine conflict, whether it's potential conflicts with China and Taiwan, and certainly ongoing issues in the Middle East, and now this here that just transpired on October 7th, which again was a tremendous, unfortunate conflict for the people of Israel. From a market standpoint, equity markets tend to price themselves in a different way. But before we get into that, from kind of that structure of kind of how we view things and changes we've implemented, Alicia, give us a little backdrop on where we've been in the past with geopolitical events as it relates to market activity in those days, weeks, maybe a month following that aspect of it. What can history tell us on that?
So what we did is we looked at 20 past geopolitical shocks going back to the 1940s. And what we found is that the initial reaction in equity markets, as far as the S&P 500 goes, is rather muted. So on average, that one-day return post that shock is down about 1.1%. And what we have seen too is the max drawdown, which tends to happen around 20 days later, is only about 4.8%. So the initial reaction is negative sentiment around what is going on. And the max drawdown isn't nearly as bad as what you would anticipate. The best part of this data is the fact that over the next 45 days or so, what we've seen is that max drawdown is completely recouped. So what we can take from this is the fact that it is important to maintain equity market participation throughout all of these sort of shocks. Yeah,
kind of that short-term immediate shock factor. What's interesting to note is that there are certain industries that may be impacted most during that initial 45-day period that Alicia's talking about. Right, the Russia-Ukraine component, we saw a tremendous energy price spike as a direct result of Russia's involvement in the refining and extraction of oil. And here now with Israel, we're seeing some of the other commodities, oil being impacted as well, technology shares being impacted as well from some companies, given Israel's involvement in that. So we're looking at that from that broader standpoint, but we've also made some changes to get ahead of potential added short-term volatility and try to mitigate some of that volatility should it occur. So this will walk us a little bit on two things. Number one, what tends to happen globally in terms of which asset class tends to benefit from this as geopolitical tensions tend to rise off the bat? And what have we done to kind of combat some of the potential volatility literally Monday morning following the announcement first thing that day?
The first knee-jerk reaction typically in markets is a flight to safety. So we're seeing a lot of assets, global assets coming into things like U.S. Treasuries, U.S. dollar-denominated assets, as well as commodities such as gold. So we are seeing that as those assets flow into things like Treasuries, we have seen yields fall. So prior to this, yields are around 4.8 on the 10-year. Now they're down to about 4.6. So we are seeing that come into fruition. With the markets closed yesterday, we're seeing that jump come today within yields.
That's a very valid point in that we always talk about reinvestment risk with Treasuries, right? Treasuries right now have this appealing yield potential of 4 to 5% on an annualized basis. Yet for an investor purchasing 3 to 6 month Treasuries, that reinvestment risk to achieve that 5% yield is amplified at any onset of geopolitical tensions, or frankly, any onset of a recovery in broader earnings or the equity market or anything of that nature. So we urge caution in that high appeal of those yields on an annualized basis to the Treasury market because of the reinvestment risk, in our view, stands higher risk-wise than that of the equity market. So a little bit on our own adjustments, rather, on the internal platform and the strategies. Walk us a little bit through that, kind of what we did Monday morning.
So we took an assessment of our international equity strategies, taking a deep dive in there and trying to gauge what is our exposure to Israel. When we look at the global indices, we can see that Israel is about 0.25% of that. Yes, very small. But what we did was we gauged that, made some adjustments there. So we feel very comfortable on where we're positioned as far as international equities go. When we look at yesterday's performance, we have benefited from our flex positioning from our buffer note positioning, as well as our positioning within the energy stocks that we own, as well as in mid-small. So far, performance-wise, relative performance looks rather good.
Yeah. Being positioned in those right sectors for this and trying to, unfortunately, take advantage of dislocations that have resulted from this geopolitical tension is what we have put into place here, into work here earlier this week. And we will be monitoring that situation very closely from a risk standpoint in an effort to ensure we don't unintentionally or inadvertently accept a higher risk level than desired.